I've been talking a lot about this great reassessment trade from what was to what is. What was on January 1st isn't what is today. What investors thought some 3 months ago, they think far differently today in terms of pro-economy, pro-market, pro-deals, M&A. Now we are in this no man's land of uncertainty. Are you as well reassessing what this market may do now?
Well, frankly, what we had been saying is reminding people that you couldn't really apply Trump 1.0 playbook to Trump 2.0, because what we got in Trump 1.0 was the candy first and the spinach later. We knew the spinach was coming first this time. It was made clear by the administration, even during the campaign season. There was maybe hope that it was going to be psychologically offset by the candy. But I'd also remind people that there's sort of a reassessment of maybe the candy, because we're not really talking about new tax cuts coming at the end of this year, the beginning of next year, just an extension of the existing tax cuts. That represents much less juice relative to what we got in 2017. And your comments, your conversation with Kaplan before, I think, was an important one, because alongside this, we're also dealing with the compression of the supply side of the labor force. And that's starting to come into the calculus and into the numbers. Not to mention, we're seeing a bit of catch down by the hard data to what has already been pretty weak soft data.
What do I do then? I mean, as in the role that you have and the way that you think big picture about the market, do my allocations change? Do I need to just rethink what I thought was going to happen for the entirety of this year? Do I dial back my earnings expectations now? All of that.
Well, earnings expectations are certainly being dialed back. You have 14 weeks in a row now where estimates for 2025 have been coming down. That's a pretty long stretch. And the loftier estimates, when we were looking at about 14 or 15% expected growth for this year, that was predicated on record-breaking profit margins. I think it's the profit margin piece of this that's being called into question. In terms of allocation, my colleague Jeff Kleintop, who's our international strategist, has really been we all have been collectively trying to pound the table on the notion that you want to be globally diversified. Harder sell when we were in the mindset of U.S. exceptionalism and the U.S. market is the only game in town, but wanted to really remind people of the benefits of international diversification. That's certainly paying dividends. And then within the U.S. equity market, Scott, you and I talk about this all the time. We've been very factor-focused with a high-quality wrapper around the factors that we have been emphasizing. And one in particular that we kind of added to the focus list as we came into this year was that low volatility factor. So I think there's a way to sort of find a little bit of an anchor and some safety within the equity market, staying up in quality, looking for that defense, bringing in factors like low volatility. And I think that's the best way to navigate this environment where rotations are fierce. The prior darlings are getting pretty slammed. So there are places to hide within the equity market, and that's basically our broad advice.
I'm glad you referenced the conversation with Robert Kaplan, who also said that stagflation is here, that this is what it is. So, it is. And this is coming from a former Fed official, no less. I've seen some notes reference that word. I'm not sure I've heard a former Fed official come out and say this is it. Stagflation can't be good for stocks at all.
Of course not, because it does put the Fed in a bit of a bind, because you've got the deflation part that limits their ability to cut aggressively into any kind of weakness in the economy. So I think it reinforces this notion that they're in pause mode, and it is probably the right position to be. I think what we're watching unfold here in real time is that the market has become the arbiters of these various policies and the nature by which we're getting information on these policies. We're not getting forward-looking perspective from the Fed because nobody knows what the near-term future looks like. But we are seeing it in the data, not just the soft data, but we're now seeing it in the hard data. I thought the personal income and spending numbers were interesting today because the income side was fairly healthy. That would typically be supportive of consumption trends, and that has been until very recently. But now you see a bit of a paring back. You're certainly seeing it in the forward-looking confidence measures in the business community, the NFIB type data, even ISM type data. You look at the verbatims from companies, and to your point about stagflation, during fourth quarter reporting season, big spike in mentions of stagflation in conjunction with recession. You see it in Google search trends. So it is absolutely in the zeitgeist now. I just did 5 client events in Denver yesterday and the day before, and that was the #1 theme of questions, stagflation/recession. So it's top of mind.